Hello guys, it's been a while. I am sorry for the interruptions in between, and it was because of the deadlines for tax audit and the transfer pricing and even the income tax returns getting deferred. The work that has been keeping me occupied for quite some time, so I was not able to put on videos. Going forward, I'll start getting more regular in terms of putting videos. And let us start off by finishing whatever is left over in transfer pricing because only a small portion is left over. So let us quickly go ahead and finish it off, and with that, we can successfully tell that transfer pricing as a topic is complete. Okay, so what all have we seen so far? So to quickly check back what we have seen so far, we understood under section 92 what are the prerequisites of transfer pricing. Then 92A made us understand the definition of associated enterprises, and then 92B gave us an insight into what is an international transaction, and then 92C gave us the methods that are generally to be adopted for the purpose of transfer pricing in terms of determination of arm's length price. And then we even went on to understand the assessment related to this thing provisions with respect to transfer pricing, and we went on to understand 92CC and CD with respect to advanced pricing agreements and the rollback provisions, and then we understood 92 CB with respect to safe harbor rules, which is no longer applicable right now. 94A with respect to national jurisdictional area, which is again not prevalent right now as there is no notified NJA. And then we understood 94B with respect to thin capitalization, where the interest was being identified as a specific point of discussion, along with comparison with BEPS action plan. And we understood section 92D, which mandated us to have a transfer pricing documentation, and the documentation had to be maintained for transactional value of rupees more than 1 crores. And then we also went over to one more section called as section 92 CE, which spoke about the secondary adjustments. Now, in amidst all this, we had gone through the range concept with respect to where multiple prices were available, and within the range concept where multi-year data was given, how to go about it was one more point we saw. And then the arithmetical mean to be used for transfer pricing determination was one more concept that we have seen. So there are quite a lot of concepts in this topic, and this is a topic which is definitely to be get tested in every examination. So it is a topic that will definitely get tested in every examination, and for paper 6C there will be a substantial amount of weightage for this topic. So make sure that you go through the lectures more than once so that you get a grip over each topic. And after this lecture is over, I will move on to a next topic, and I will also start putting in videos of problems being solved on this particular topic to show you as to demonstrate as to how the presentation needs to be done in order to safeguard yourself in terms of getting the rightful marks for your answer. Now, what is the topic that is left over in transfer pricing? There are two areas which we have not covered. One, with respect to documentation for transfer pricing, there were two other documentations which we have not touched upon. One is the master file, and the other one is country by country reporting. And then the other area which we are yet to touch upon is the specified domestic transactions and the transfer pricing implications thereon. Now, what is this country by country reporting? See, there is a topic called as base erosion and profit shifting, which we will be looking at, as I had told you earlier, in a separate lecture, that has a number of action plans to be incorporated in order to ensure that undue advantage is not taken on account of tax legislation. So, one such action point is going to be action point number 13 for uniform transfer pricing policies. Now, in accordance to this particular action point, in accordance with this particular action points, every entity in a group, or every group, let us not go into every entity in a group, every group is to maintain three documents. Every group is to maintain three documents. So what is a group, sir? So I have the notes ready. So let me take you with the notes so that you don't feel the dryness of the topic. So on top of it, let me give you some examples. Now, Acer US Inc. Then Acer India Private Limited. Then Acer Japan Corp. Then Acer Singapore PTE Limited. Okay, and then Acer France Inc. So there are totally five entities. Okay, there are totally five entities. Each of these entities are being held by the each of these entities, there are totally five entities, of which four of these entities are being held by Acer US Inc. And Acer US holds 100% shares in all of these entities. So, as per 92A, the restriction is only up to 26%. If you hold more than 26%, you're automatically associated enterprises. So, these are associated enterprises, right? Now, these four entities belong to Acer Inc. So, as per Companies Act, this entity will be called as holding company or parent company, and this will be called as subsidiary. Correct? This is what we will be referring to in terms of Companies Act, and then in your financial reporting, everywhere this is how we generally refer to it. But from an income tax point of view, this is called as a group. All these five entities together are called as a group, and since they are located in various countries, US, India, Japan, Singapore, France, they are called as multinational group. So in movies that you hear about multinational companies and multinational group is all about this. It's not only Acer, any company for that matter, Microsoft, Google, Adobe, whatever you have, whatever big names you have today, they are present in various countries. This is called as a multinational group. So OECD felt that this multinational group might have transaction amongst themselves. So ASL US might sell to India, might sell to Japan, might sell to Singapore, might sell to France, or it might purchase from all of these entities, or there might be purchase within these entities also. So now, as per our definition, all of them are associated. So if there is a transaction between Acer India and Acer Japan, they will be subject to transfer pricing because all five are associated enterprise. You can't tell Acer and India, US and India are associated, US and Japan are associated, US and Singapore. No. India is associated with US, India is associated with Japan, India is associated with Singapore, India is associated with France also. So assume that India purchases from France, and then India purchases from Singapore, India purchases from US. Now there should be a uniformity in the transfer pricing policy. So whenever there is a transfer between the group, OECD wanted to ensure there is a uniformity between the transfer pricing policies. So first they wanted to know what was the transfer pricing policy of the group. Instead of finding out for the Indian entity alone, they wanted to know the transfer pricing policy of the group. So this transfer pricing policy of the group had to be understood and appreciated before any transaction was scrutinized. So they wanted this to be reflected in a document called as master file. So this master file will tell how many entities are there in the group. So this structure that I have drawn here will be there as part of the master file. So how many entities are there as part of the group? Then what businesses these entities are carrying out. One is selling laptop, one is selling software, the other one is trying to do after sales services, and the one is doing the update service, etc. So like this, the business of the enterprise is also given. Then anytime India sells a laptop, Japan will come and do the software related work. So this is what there is a software agreement or service agreement between Japan and India. So this is also highlighted in the master documentation or the master file. So master file, what all it will do, it will try to first list out what are the entities in the group. Two, it will tell what is the organization structure in the group, and then it will tell what are the various businesses that are carried out in the group. Then it will go ahead and also tell what are the various service agreements which are material to this group. So this is what the master file will tell, and it will give a synopsis of the various transfer pricing policies within the group. It will try to give synopsis of various transfer pricing policies within the group. This is called as the master file. So BEPS Action 13 told first have a master file. Why? This will give an overall summary, overall broad picture or a very executive picture of the group. Now that your mind is set as to okay, so this group is a software group, okay, this group is a manufacturing group. Now that I know this, let me go and look into the transactions. This is second stage. What will I do? First, I will understand what the group is. Then the second stage is to find out what are all the transactions in the group. And what is the price they have charged for these transactions? How did they find the arm's length price? How did they find out the most appropriate method for applying the arm's length price? What was the adjustment that was made suo moto? Whether all transactions which are to be reported are reported, this is to be incorporated in a file called as local file. This is what we have seen under section 92D, transfer pricing documentation or local report, local file or transfer pricing study report. So this is called as local file. Master file is a new topic which we have just now understood to be a broad picture of the entire group. Now, I have understood that there are so many transactions in this particular Indian entity. So this will be specific. Local file will be specific to AIPL. Local file will be specific to AIPL. Master file will cover the entire picture. It will not stop with AIPL alone. Clear? Now, I have understood what is the master file. Based on that, I have gone and scrutinized the transactions provided with the document, the help of documentation. I have followed everything. Now, whether this is in line with the group's revenue, group's profitability, group's capital employed, group's human resource employment. This is what I want to check and understand with the help of country by country reporting. So, what is the total picture of the group? Of that total picture, what belongs to India? Of that total picture, what belongs to Japan? Of that total picture, what belongs to Singapore? Of the total picture, what belongs to France? The documentation which gives me this bifurcation and the consolidation is called as the country by country reporting file. So I don't only stick with my country alone, I make sure that other countries are also informed about whatever is happening here. So this is the broad picture. Now, there are few terminologies we have to understand. This is example number 1. Just keep it so that you will get a clarity on both sides. Example number 2. Let us take Logitech India Limited, and they have 5 subsidiaries. Okay, Logitech UK Private Limited, then Logitech US Inc., then Logitech Japan Corp, Logitech Malaysia Pty Limited, and finally Logitech Korea. Okay, so there are 5 subsidiaries to the Indian company Logitech India. Okay, so there are 2 examples here. So again, as per Companies Act, if you see, they will be considered as holding and these will be considered as subsidiary. These will be considered as subsidiary, correct? And from the group reporting point of view, this is called as Logitech Group. This is called as Logitech Group. Now, the entire premise of country by country reporting is based on 2 terminologies. One, parent entity constituent entity. So there are 2 terminologies. What are they? Parent entity and constituent entity. So what is a parent entity? That entity which prepares consolidated financial statements. So whichever entity prepares consolidated financial statement, that entity is considered as parent entity. Every other entity is supposed to be called as every other entity is supposed to be called as constituent entity. So in our example, Acer US Inc. is the parent entity. All these are called as constituent entity. Logitech India is parent entity. All other Logitechs are constituent entities. Is it clear? So these are terms we must understand because they will be used interchangeably they will not be used interchangeably, they will be used repetitively going forward into the concept of CBCR. Okay, so what is CBCR? Country by country reporting. So we have to know that parent entity is the entity which prepares consolidated financial statements. Constituent entity is the entity other than a parent entity. Now, some of you might have this doubt. Sir, you are giving a very plain example, sir. Suppose Acer India Private Limited or Acer Japan Private Limited has another this thing. What is that? Has another subsidiary called as Acer Japan Private Limited. Acer Japan Private Limited. Now, Acer Japan will also prepare consolidated financial statements. Yes. So can I tell Acer is a parent entity? No. Acer Japan is only a part of the group, not the full group. Acer Japan does not consolidate for the entire group. Acer Japan consolidates for the limited purpose of its own financial statements. So the consolidation that we are talking here is for the ultimate parent from a company's act point of view or a financial reporting point of view, and not for the step subsidiaries which have some consolidation done to the immediate parent. Immediate parent will not be considered, ultimate parent will be considered for the purpose of determination of parent entity. Is it clear? So parent entity will be the ultimate parent which files the consolidated financial statements. Now, with this basic knowledge, let us jump on to see what is there in this particular concept of CBCR. Now, just follow me as I keep reading through the provision. I will explain so that you will be able to follow and not blindly look into the white screen while I talk. Now, what is CBCR? It is a requirement for reporting of the MNEs, multinational entities. So these multinational entities only have to go ahead and report. Okay. Now, if there is going to be an entity in India which has 25 subsidiaries in India, this will not even apply because this is for multinational. Everything is in India, so nothing to bother us. So we will ignore it. Now, submitted by parent entity of the group to the prescribed authority in the country of residence based on consolidated financial statements. So what is the meaning of this? Our example. Let us take our example. So in this case, Acer US Acer US will file Acer US will file country by country reporting CBCR in USA. So the parent entity will file CBCR in the state or sorry, in the country in which it is a resident. The parent entity will file CBCR in the country in which it is a resident. And what is a parent entity? An entity which prepares the financial statements on a consolidated basis for the entire group. Now, in our other example, this they will file CBCR in India. So, Logitech example, CBCR will be filed in India, and in case of Acer US, Acer example, CBCR will be filed in US. Okay, so CBCR as a concept is not always to be filed in India. Okay, first we have to find out whether India has a parent entity. If India has a parent entity, then India will have to file CBCR. If the entity in India is a constituent entity, it need not file CBCR. Sir, what about exceptions? Exceptions are there. Let us first understand the law before we get to the exceptions. So, who will file CBCR? The parent entity preparing consolidated financial statements of the group will file CBCR in the country in which it is a resident. Now, let us jump back to the provisions. And what is the basis? Based on the consolidated financial statements of the group. So, who will file? Parent entity. And then, who and to whom will they file? To whom will they file? Prescribed authority. Who is the prescribed authority? Obviously, income tax authority of the respective country and in the country of residence. So, prescribed authority in its country of residence based on consolidated financial statement of the group. That is why intermediate parents will not file this thing CBCR. Now, multinational groups report annually for each tax jurisdiction where they do business. So, what should they report? Now, what should they file is given here. So, they will file CBCR in the country in which they are resident to the tax authorities in that country. And what will they file? They will file amount of revenue, they will file profit before tax, taxes paid thereon, profit after tax, amount of human capital employed during the year, and then what is the expenditure incurred on tangible assets purchase, capital expenditure, and reserves and surplus, whatever they have accumulated over the year. So these are generally the list of items that they will report, and these are the items that they will generally report. Groups identify entities within them doing business in a particular tax jurisdiction and indicate business activities of each entity engaged in. Now, what is the meaning of this? Let us go back to our example. So here, let us take Logitech. Logitech will file CBCR in India, and what will they disclose? They will disclose consolidated revenue, PBT, profit before tax, profit after tax, taxes, workforce employed, and then capex incurred, and these details will be given. And apart from this, Logitech will also specify we have 5 subsidiaries. Okay, and they will list A, B, C, D, E. So these 5 subsidiaries they will list: UK Private Limited, US Inc., Japan Corp, Malaysia, Korea, and then they will give the address and the location of these subsidiaries. So they will not only report these, they will also speak about the constituent entities. Who are the constituent entities? Any entity other than the parent entity in the group is called as the constituent entity. And what else will they report about the constituent entity? They will go ahead and report within the identify entities within them doing business in a particular tax jurisdiction. So Logitech will tell we have 5 subsidiaries who are doing businesses in various countries. So they will tell Korea, Japan, as US, etc. So they will go ahead and tell that and indicate the business activities each entity is engaged in. So what all will they do? They will report this. They will tell we have so many entities located in other countries, and these entities are engaged into the following business. One will go ahead and supply, one will carry out the services, one will do the after sales, one is into marketing. Like this, they will try to give the brief description of business activity carried on by each of these entities. Is it clear? Fine. Now, let us quickly look into the bullet provisions which are relevant for us from an examination point of view. See, whatever we have seen till now is also relevant, but this could be helpful even for your MCQs. So, when is it to be filed in India? So, first question will be, when will CBCR be filed in India? So, what did we understand? First of all, CBCR is to be filed by whom? The parent entity. Now, who is the parent entity? Entity who files consolidated financial statements. If the parent entity is in India and he files financial statement for the entire group, then only there has to be a responsibility to file CBCR in India. Okay, what is alternate reporting entity, sir? Wait for that. Let me come there. I have not yet discussed about alternate reporting entity. I will tell you what is alternate reporting entity. So this is alternate reporting entity. This is parent entity. This is constituent entity. So parent entity or alternate reporting entity is resident in India, and very important, group revenue as per consolidated financial statements for the preceding year is 6,400 crores or more. So, if I take the P&L, consolidated P&L, if I take and check revenue from operations should be 6,400 crores or more than that. Only then the provisions of CBCR will be applicable. Is it clear? So what are they telling? First of all, there has to be a parent entity in India, and that parent entity should consolidate in India, and the parent entity should consolidate for the entire group, and the parent entity should also have a consolidated revenue and statement of profit and loss for 6,400 crores or more. So these two conditions should be satisfied together. Only then you have to file CBCR in India. You will have to file CBCR in India. Now, what is an alternate reporting entity? Sometimes what will happen, the parent entity will feel that let me not do this, let me not do this. For example, let us come to our example itself. Acer US feels that, boss, I have too many things to be done. I am not interested in filing all this country by country reporting. You please take care. So they designate. What are they doing? Designate. Who is designating? Acer US is designating Acer India to file the country by country reporting. That point of time, Acer India will be called as alternating reporting entity. It's called as alternate reporting entity. When it is designated by the parent company, the company which is designated by the parent company or the constituent entity which is designated by the parent entity is called as the alternate reporting entity. Is it clear? So that is an alternate reporting entity. We found out what is parent entity. We know what is constituent entity. Now we also found out when it is to be filed in India. When will it be filed? If consolidation happens in India and the parent is located in India, or alternate reporting entity of a foreign parent is located in India, and the total consolidated revenue of the group is 6,400 crores or more. Up to last year it was 5,500. They have amended it. That is from November 21 exam. It has been amended, if I am right. Or maybe from May 22 exam it has been amended. 6,400 crores is the limit. Now, and it is to be filed with whom? It is to be filed with joint director of income tax, and this joint director will generally be designated by the risk assessment or the systems division of director general of income tax or principal director general of income tax. Generally, initially it was to be filed only with director general and principal director general, then it was designated to joint director of income tax. Now, so what is the time limit for filing, sir? Is there any time limit? Because for income tax return, we have time limit. For transfer pricing report, we have time limit. Like this for country by country, is there a time limit? Yes, 12 months from the end of the relevant accounting year. So for example, if I am filing it for FY 2021-22, time limit will be what? 31 3 2023. So if I file for FY 21-22, 1 year from the end of the relevant financial year, so 31st March 2023 will be the timeline. Is it clear? Now, sir, is there any form for filing this, sir? Yes, as we have been discussing, transfer pricing certificate in form 3CEB. Likewise, here there is a form called as 3CEAD. What is it? 3CEAD. 3CEAD. So will they ask forms in the examination? See, there is no clarity in that regard. Generally, they don't ask, but now that MCQs are online, we never know what they are going to do. So it is better to know. It is not very hard, and the number of forms are also limited in this topic. So take one topic at a time, just go through it. You will definitely have the memory to retain them. Now, so what all have we answered so far? When is it to be filed? To whom is it to be filed? And what is the time limit for filing? What is the form for filing? Now, Acer Inc. wants to file. Okay, if Logitech is filing, Logitech will prepare its consolidated financial statements in what currency? It will definitely prepare it in Indian currency, correct? Because parent is in India, subsidiaries are abroad, they will convert everything, or then they will take it to FCTR, and you know the financial reporting nuances better than me. So they will consider the INR as the primary currency or the functional currency based on which the reporting needs to be done. But when it is done by Acer US, Acer US is the parent entity, others are all constituent. Acer US has designated Acer India Private Limited as the alternate reporting entity. Now, Acer India has to file Form 3CEAD for country by country reporting. If he takes the financial statement, he sees the entire amounts in dollars. Now, how will he convert it? So, for this, there is a rule 10DA which is specifically telling that TT buying rate. What rate? TT buying rate on the last day of the preceding accounting year should be considered for the purpose of conversion. So wherever the consolidated data is in foreign currency, that consolidated data shall be converted to Indian currency using the TT buying rate at the last day of the last accounting year. Is it clear? So 31st March TT buying rate shall be considered. Now, Now that we have understood regarding the filing purposes, we have answered the question from whose point of view? Parent entity's point of view. What is the role of constituent entity? What is the role of constituent entity? Now, let us take the example of Acer. Acer US is telling that don't worry, Acer India, I myself will file this thing country by country reporting. So Acer India is not an alternate reporting entity, correct? Now, will the income tax department know this? They won't know. So you will have to go and inform them. There is therefore one additional responsibility for the constituent entity. What should they do? They have to file Form 3CEAC. Form 3CEAC at least 2 months before the due date of Form 3CEAD. What is the due date for 3CEAD? 12 months from the end of the accounting year. So 31st March 2023 is for CBC reporting. 31st January 2023 is for Form 3CEAC, where a declaration will be made as to whether Acer India is an alternating reporting entity or not, and then it will have to go ahead and tell the details of the parent entity, Acer US Inc., and it will also have to, in case Acer has made Acer Japan as alternate reporting entity, it has to give data of Acer Japan as the alternate reporting entity and the country of their residency. So what will the constituent entity do? The constituent entity will go ahead and file a form with the income tax department in Form 3CEAC and confirm that they are not a parent, or they are not an alternate reporting entity for the group, and then the parent or alternate reporting entity has to be disclosed along with their country of residency. This is what a constituent entity is supposed to do. And what is the time limit that they have for filing this form? It is 2 months before the date of filing CBCR. So is it clear? So what have we seen so far? CBCR, duties of parent or alternate reporting entity, duties of constituent entity. So this portion is talking about what the parent needs to do. This portion talks about what the constituent entity needs to do. Is it clear? And wherever I talk about parent, if the parent has referred to an alternate reporting entity, the obvious responsibility will be shifted to the alternate reporting entity. Is it clear? Now, let us go on to the next provision. When will the constituent entity in India be required to file CBCR? Sir, whenever they are considered as alternate reporting entity, sir, yes, you are right. Whenever they are alternate reporting entity, they are supposed to file. Agreed. But can there be exceptions to the rule that only parent or alternate reporting should file? Yes, there can be. That exception is what is getting covered here. So what did we tell? Generally, CBCR filed by parent or ARE, but exceptions, then constituent entity shall file CBCR. So what are those exceptions? So let us try to understand what are those exceptions. Now, where parent entity resident of a country where CBCR is not obligated. Now, India during the year 2018 only they mandated CBCR. So there was a notification number 88 which came out on 18th December 2018 where they mandated the application of master file and CBCR. Okay, before that this was not there in India. Likewise, there might be countries where CBCR might not be obligated. Let us take for example Mauritius. There is a company in Mauritius and the parent company is located in Mauritius. One of the subsidiaries is in India. One of the constituent entities in India. Parent entity is in Mauritius. This parent entity is located in a country where this CBCR is not mandated. In Mauritius, for example, CBCR is not mandated. Now, CBCR will obviously not tell any alternate reporting entity, will not allocate any alternate reporting entity because it is not mandated. So it has not told any other entity to be an alternate reporting entity. In this case, what will happen? The Indian entity which is located in India will be forced to file country by country reporting. So where the parent is located in the country where CBCR is not obligated, Indian entity shall file CBCR even though they are not the alternate reporting entity. So in other words, where the parent entity is located in a country where CBCR is not obligated, constituent entity shall file CBCR. and we are talking only from Indian point of view, because here we are talking about what happens in India. Okay, so now second point, if the parent company is located in a country with which India does not have arrangement for exchange of information of CBCR. Now, remember one very important point. When the parent company files CBCR in the country of its residence, that country's tax authorities, you know what they will do? They will check what are all the subsidiaries for this particular company and what are the country of residence, and they will share this information with the income tax authorities of the other countries. So let us go to this example. Now, Acer US Inc. files the CBCR with US tax authorities. US tax authorities will share this information with the Indian tax authorities, and then they will share it with Japanese tax authorities, Singapore tax authorities, and France tax authorities. So there should be an agreement between the two countries that they will share or they will exchange information corresponding to country by country reporting. Okay, so if there is no such arrangement, for example, Cayman Islands and India does not have an arrangement for exchange of information with respect to CBCR. For example, CBCR information exchange, there is no agreement between India and Cayman Islands, and the parent entity is located out of Cayman Islands. Okay, and if that is the case, if Cayman Islands appoints someone in some other country or in India as an alternate reporting entity, it is okay, no problem. But however, Cayman Islands has not appointed such an alternate reporting entity, then within 12 months from the end of the accounting year, in both the cases, CBCR shall be filed by the Indian constituent entity. So, what are we trying to tell? If the parent entity is resident in a country where CBCR is not obligated, so no CBCR requirement in a country. Case number two, where with which India does not have an arrangement for the purpose of exchange of information relating to CBCR, then within 12 months from the end of the accounting year in the above cases, CBCR shall be filed by the Indian constituent entity, even though it is not an alternate reporting entity. Is it clear? So these are the two exceptional cases, and then there is a third exceptional case. Now, Acer US Inc. has filed the CBCR report with US tax authorities. Now, Indian tax authorities are asking the US tax authorities to share the CBCR information. However, the US tax authorities have not shared it because of some problem or because of some issue. Now, and this is not one case where this is happening. Almost 3-4 cases the same issue has repeated. Now what has happened? There is a systematic issue that has happened with respect to US tax authorities and Indian tax authorities. So to avoid this issue, JDIT, Joint Director of Income Tax, of the Indian constituent entity will go ahead and tell boss, you file the CBCR because we are unable to get the information. Okay, then within 6 months from the end of the month in which the failure is intimated by the JDIT, Indian constituent entity shall file CBCR. Is it clear? Let me repeat. If the parent company's income tax authority or the parent country's the parent company's residence country's income tax authority have had a systematic failure or a systematic issue or systemic issue in terms of sharing the information with the country of constituent entities or the Indian constituent entity, then the JDIT may send out an intimation asking the Indian constituent entity to file the CBCR report, and the time limit to file such CBCR report shall be 6 months from the end of the month in which an application intimation is received from the is received from the JDIT. So in this example, let me give you. So in this example, let me give you one example. So JDIT has intimated. So JDIT has intimated on, let us say, 18th of December 2021. So he has intimated on 18th of December 2021. Please file the country by country reporting, for example. Then what is the time limit available? first go to the end of the month, 31/12/2021, and 6 months from here. So which will be 30th of June 2022 will be the due date. 30th of June 2022 will be the due date within which they will have to go ahead and file the country by country reporting. So there are three cases where the constituent entity, though not the alternate reporting entity, will have to file CBCR. Generally CBCR who will file? Parent entity or alternate reporting entity. There are three exceptional cases where constituent entity will file CBCR in India. What are they? Case number one, the parent company is resident of a country in which CBCR reporting is not at all obligated. Therefore, there is no requirement for parent to file CBCR. Therefore, for the CBCR information, constituent entity will now become liable to file CBCR. Case number two, where there is no agreement to share information between the country of parents residents and the country of constituents residents. Therefore, the parent company will not share information. The parent company's parents resident countries tax authorities will not share it with the income tax authorities of India, being the constituent entity. Therefore, what will happen? Indian's constituent entity will have to file CBCR. Now, the time limit for these two cases will be 12 months from the end of the accounting year. Now, third case. What is the third case? Suppose there is an agreement, okay, and they are also obligated to maintain. You are a parent. Now, what has happened? But they have not shared the information. Who? The income tax authority of the country of residence where the parent is located has not shared the information, or there is some systematic error or systemic error between these two countries. Then what will happen is that they will go ahead and ask the constituent entity to file the CBCR reporting. Who will ask? The joint director of income tax will ask the constituent entity to file, and the constituent entity shall file it within what period? 6 months from the end of the month in which the joint director has requested them to file the CBCR report. Is it clear? Now, let us move forward. Suppose in the Acer example, or let us take in the Acer example, there are two entities in India. There are two entities in India instead of one entity. There are two entities in India. Then one resident constituent entity can be nominated in Form 3C EAC, who shall furnish the Form 3C EAC on behalf of the group. So, sir, can it be in US itself? Yes, it can be in US itself. Can it be in India? It can be in India as well. So, but if it is in India, there are two entities are there in India. They can designate one of the entities in Form 3CEAE. It can be designated in Form 3CEAE as the alternate reporting entity. So, alternate reporting entity are designated in what forms? Form 3CEAE. But it should be done by whom? It should be done by the Indian company. For Logitech has 3 entities in India, 5 entities outside India. And Logitech wants one of the Indian subsidiaries to go ahead and file. They can still do it. It is an international group, they can still do it, and this designation will happen in Form 3CEAE. Okay, and what is the time limit? There is no specific time limit that is given for Form 3CEAE. Now, we have seen three exceptions. Now, suppose in those exceptions, the parent has appointed another alternate reporting entity. Suppose the parent has appointed another alternate reporting entity. For example, Acer US, there is no requirement to file CBCR, but Japan it is required to file. So what US does is it asks Japan to file CBCR. Japan files CBCR. Japanese income tax authorities shares the information with Indian income tax authority. Indian entity need not file CBCR. So what is the meaning of this? If the parent being unable to file CBCR or is unable to share the information, or if there is no agreement, appoints another alternative reporting entity, and such alternate reporting entity has filed CBCR and the information is shared, these three exceptions will not hold good. No parent entity, no alternate reporting entity, no information, only then these three will hold good. Otherwise, these three will not hold good. Is it clear? So that is the only exception that we have discussed here. However, if the non-resident parent designates an alternate reporting entity and CBCR filed within the due date by the alternate reporting entity, then the constituent entities need not furnish Form 3CEAD if income tax authorities can obtain the info from the tax jurisdiction of the ARE. So Japan is sharing the information to India. Therefore, Indian subsidiaries need not file Form 3 CE80, which is the country by country reporting. Is it clear? Now, next one. Now, Japan has given the country by country reporting. But Indian authorities have also taken the TP study report from me. Now they want some more information. They feel that no, no, I think some more information is available with Japan. If it is available with us, we can use it for the purpose of assessment. They can ask the Japanese income tax authorities to share the information with Indian income tax authorities. So Indian income tax authorities can ask the other entity to share the from the entity furnishing the CBCR for the purpose of verification of accuracy. So you can directly ask the Japanese entity, Acer Japan Corp, for the purpose of sharing of information to check the accuracy of information disclosed in Form 3CA, sorry, disclosed in CBCR. Now, what is the time limit that Japanese entity will get? 30 days, and additional time of 30 days can also be allowed for this purpose. So, maximum of 60 days can be given for the purpose of obtaining of information. Is it clear? No. Is there any penalty clause for this? Very much yes. So as a parent entity, you are supposed to fail CBCR, or as an alternate reporting entity, you are supposed to fail CBCR, and you have not filed CBCR up to 1 month. The penalty will be rupees 5,000 per day. From the date the default begins up to 1 month, you will have to pay penalty at the rate of 5,000 per day. So maximum penalty will be lakh and 50,000 for 1 month. Then beyond 1 month, you will have to pay penalty of rupees 15,000 per day. So from the 31st day, you will start paying 15,000 per day. Now, this what is this? Now, I have not paid for 60 days. Okay, so first 30 days I would have had a penalty of 5,000, and for the next 30 days I would have had penalty of 15,000 per day. After 60 days, department is getting annoyed and they are thinking that I have forgotten about the entire issue, and they send me a penalty order telling that boss, you have to pay penalty of 60 days, of which first 30 days the penalty will be 5,000 per day, next 30 days penalty will be 15,000 per day, kindly remit the same update and they send the notice to me. They send the penalty order to me. I have not responded to the penalty order. I have not what? Responded to the penalty order. If that is the case, 50,000 per day from the date I have received the order will be levied as penalty. So what is the case? From the date of service, what is service? The date I received. So date of service of notice or order will be considered as the starting point of levy of penalty of rupees 50,000 per day. So these are the penalty clauses where I don't furnish the report. Now, I am the parent entity. I have filed CBCR to the income tax department. CBCR against CBCR, income tax department is calling out for information. Okay, they are calling out for information and documentation. I don't furnish this. I don't furnish this within the time period given by them to me. So they tell that boss, give me the information within 30 days. Department sends a notice to me. I am the parent entity, Logitech India Limited. They have asked me for information about the group. I have not responded to this for 30 days. 31st day onward, 5,000 per day will be the penalty. Okay, 31st day onwards, penalty will be 5,000 per day. Again, for 45 days, they wait and see. I don't pay the penalty, I don't give the information, I don't respond. Also, they send an order, they send a penalty order telling that boss, you have forgotten, you should pay this much. And I have not responded to this order. So, from the date of service of order, every day's penalty will raise from 5,000 to 15,000. Okay, so there are two penalties here, don't get confused. Penalty number one is for non furnishing of report, penalty number two is for non furnishing of documents and information. What is the third one? Now, I have submitted some information. Okay, consolidated P&L, I have given some information, some expenditure, or probably, or some capital expenditure. I have given some information, or probably I have given some information on employee turnover, etc. And while filing this CBCR itself, I know that information is wrong, but still I have gone ahead and filed case one. Case two, after filing, I realized, oh God, I have done something wrong. But I have neither intimated the department nor have I made any efforts to change it. Case number two. Case number three. I have given wrong information. I have given wrong information with respect to any data that was called for. They have called for some information. Knowingly, I have given some wrong information. Under these three cases, there is a fixed penalty of rupees 5 lakhs. There is a fixed penalty of rupees 5 lakhs. So, what is the penalty for submission of inaccurate information in CBCR? Okay. So, this is the penalty for inaccurate information. Now, there is a section called Section 273B, where there is an immunity granted to penalty, where there is a reasonable cost that has resulted in the penalty. Okay, so they raise a penalty and they give it to me. I am telling that the entire office was shut down because of COVID. MD died, so no one was there to authorize the payment. So they are giving some reasons which are genuine. Nothing can be done, and probably there was a flood. So because of that, the office premises has been broken, and the access to internet has been shut down for quite some time. So something like this, which cannot be avoided, where there is a genuine reason, then they will generally let go of the penalty. This penalty is applicable for this waiver is applicable for various penalties. Okay, and this waiver or this benefit is extended even to 271 GB. So you will have to go ahead and make an application to the income tax officer specifying that this is the reason why you are not able to comply with the penalty requirement. So kindly make sure that this penalty doesn't materialize, and then they will help you with the penalty option. So this is with respect to section 273B. That brings us to the conclusion of what is called as country by country reporting. What is country by country reporting? This country by country reporting is based on the parent entity of a group which goes ahead and reports the parameters that are required to be reported. And the parent entity, when it is located in India, or the alternative reporting entity when it is located in India, then CBCR will be filed in India in form 3CEAD, and the time limit to be filed will be 12 months from the end of the financial year, the accounting year, and it will be filed to JDIT, who is designated by PDGIT or DGIT. Now, if there is going to be a constituent entity in India, the constituent entity in India should file Form 3C specifying that they are not or they are the alternate reporting entity, and they should also give details regarding who is the parent entity and the country of residence. Now, if there are two entities in India and one entity needs to be designated for Form 3CEAD, then the designation shall be done in Form 3CEAE. Okay, there is no time limit given for this purpose. And then what else have we seen? There are certain exceptions to 3CEAD to be filed only by parent or alternate reporting entity. What are they? Where the parent entity is located in the jurisdiction which is not obligated for CBCR, then the constituent entity in India is bound to file, and time limit is 12 months from the end of the accounting year. Where the parent entity is located in the jurisdiction with which information exchange agreement is not available between the country of residence of parent and the Indian tax authorities, then Indian constituent has to file the 3CEAD with respect to CBCR. Then what is the other one? With respect to uh, information which is being shared by countries which are obligated, but such information is not made available, and then there is a systemic error or systematic issue between these two countries in terms of exchange information, though there is an agreement and though there is an obligation, then JDIT might intimate the constituent entity to file Form 3CEAD within the time limit. Okay, so and you will have to file within 6 months from the end of the month in which intimation was received. And what was the penalty provisions that we have seen? Penalty provisions will be with respect to non-filing of report, non-furnishing of report, 5,000 per day up to 1 month, and 15,000 per day beyond 1 month. Where a penalty order has been issued, rupees 50,000 per day from the service of order, date of service of order. Where there is a non-furnishing of information and documents, or where there is an information and documents called for and you have not furnished, then failure to produce within the time limit given for furnishing it, then you will have 3,000 rupees per day as penalty from the day after which the time limit given expires. And where there is a penalty order issued and you have not responded to it, every single day after the date of service of order shall be subject to a penalty of rupees 50,000. Where an information has been called for and you have filed CBCR knowing that the information is wrong, or you identified that the information was incorrect after filing but you have not informed the officer and corrected it within a period of 15 days, and inaccurate information or document was submitted in response to a notice, then there is a penalty of rupees 5 lakhs. However, 273B immunity towards penalty is also made extended towards section 271G. Is it clear? GP, sorry. Now, So we have understood what is country by country reporting. Local file, anyways, we have seen under 92B. The only leftover portion is master documentation or master file. So what is this master file? Who does it apply to? It applies to every constituent entity of the international group. So who are the constituent entity? These are the constituent entities. So every entity will have to go ahead and file the master documentation. Whether they are parent or not, no. This is not even talking about parent, it is talking about constituent entity. Okay, every constituent entity of the international group where the consolidated revenue of the group is greater than 500 crores. So CBCR 6,400 crores. Here it is simply 500 crores. If the group revenue is more than 500 crores, every constituent entity in the group will have to file master file. Be very careful. It is every constituent entity. It is not about parent or alternate reporting. Every constituent entity will have to file. Now, aggregate value of international transactions during the accounting year should be more than rupees 50 crores. So all international put together should be more than 50 crores. Or if there is purchase, sale, transfer, lease, or use of intangible assets. So purchase, sale, transfer, lease, or use of intangible property during the accounting year greater than 10 crores, then you will have to consider the master file reporting. So there are two conditions. Technically, there are two conditions. What are they? Consolidated revenue should be more than 500 crores, and that is why please the word and is being used. And aggregate value of international transactions are more than 50 crores. Satisfied master file. Sir, aggregate turnover is more than 5 sir. Group turnover is more than 5 sir. 500 crores sir. But aggregate value of international transaction is only 30 crores sir. Then immediately go down and check. Purchase, sale, transfer, lease, or use of intangible property in India greater than 10 crores. Yes. Then file master file. Okay. So this plus this or this plus this. That is how you will see and apply the master file requirement. Now, who is it submitted to? Just like CBCR, it is submitted to the Joint Director of Income Tax, who is designated by the Principal Director General of Income Tax or Director General of Income Tax. Then, what is the form number? The form is 3CEAA. 3CEAA, which is considered for the purpose of master documentation. And what is the time limit? It is exactly the same date, which is the date for income tax return. So 30th of November should also be the date for master file. If you file income tax on 30th of November, master file is also on the 30th of November. Okay. Now, if there are more than one constituent entity in India, now there are three constituent entities in India. Okay. And should all these entities furnish 3CEAA? Not necessary. For example, in this, let us say that there is one more Acer India. Okay, there is one more Acer India. Now, should both these furnish? No. Only one should furnish the master file. It is enough if one furnishes the master file. Who has to furnish? That they will go ahead and designate. So, one entity is designated by the group and it is conveyed in form 3CEAB to the JDIT at least 30 days prior to furnishing 3CEAA. So, what should Acer do? Acer India Private Limited is one entity. Acer India Services Private Limited is another entity. There are two entities. Now, Acer US tells let Acer India file 3CEAA. Then Acer India will go into the income tax website and file form 3CEAB telling that with respect to Acer Group, Acer India Private Limited will file the master file. They will go and designate themselves and report it to Joint Director. What is the time limit? 30 days before the date of filing return of income. So transfer pricing cases will always be 30th of November. So 31st of October is the due date. 31st of October is the due date for filing 3CEAB. For 3CEAB it is 31st of October. 3CEAA it is 30th of November. Clear? So when will 3CEAB come? There has to be multiple constituent entity in India and not all are required to file master file. It is enough if one files. Who will file? That person has to go and designate in the income tax website via form 3CEAB that he will be a designated entity for the purpose of filing form 3CEAA. Okay. Now, whatever documents are there as part of this particular group transactions and whatever is given as part of master documentation should be retained for a period of 8 years. So whatever documentation they hold should be retained for a period of 8 years. Now, all entities given in what is the content of this master file. Like I had told you at the beginning of the session, who are all the entities that are there in the group, and who is the parent entity, what is the name of the group, what is the organizational structure, what is the business of each of the entities, and what is the business of the entity as a whole, the group as a whole, and then what is going to be the major service agreement between the entities, groups, etc., will be specified as part of the master file. Okay, so this is with the respect of master file as well as country by country reporting. Okay, so that concludes our journey with respect to the documentation portion for transfer pricing. Last segment which is still left over is the specified domestic transaction. Now, transfer pricing initially was made applicable only towards international transactions. It was never a part of domestic transactions. Then what happened? People started doing certain transactions like this. Now let us take Acer India Private Limited. Okay, there are three units. One unit is located in Bangalore. One unit is located in Hyderabad. And another unit is located in Uttarakhand. Okay, this Uttarakhand unit is eligible for 80IC benefit. 80IC benefit, so they are eligible for 100% reduction of profits. 100% reduction of profits. Okay. Now, Bangalore Bangalore will sell to Uttarakhand. Hyderabad will sell to Uttarakhand. Uttarakhand will sell to final customer. So what is the transaction? Bangalore and Hyderabad division will transfer goods to Uttarakhand. So it is an inter-unit transfer, correct? It is an inter-unit transfer. Or let us assume that there are various small subsidiaries for Acer. There are small subsidiaries, Acer Bangalore Private Limited, Acer Hyderabad Private Limited, Acer Uttarakhand Private Limited. Let us take it off like that, or within the group also, as the case may be. They transfer it here, and whenever they transfer 10 crores worth of goods, if sold in the market, it is 10 crores, but they transfer it for 7 crores. Here, 10 crores worth of goods, they transfer it for 6 crores. Now, here 20 crores worth of goods is sold for 20 crores. Now, let us analyze what will happen. Revenue of this particular division will be down. Revenue of this division will be down. Cost of this division will be down. Okay. Profit of this division will be down. Profit of this division will also be down. Whereas profit of this division will be up. Correct? Why? Because they have sold at higher rates, purchased at lower rates, this division. Now, what will happen from a tax point of view? Whatever they sell here is not taxable, it is deductible. So tax free, correct? Because 100% tax benefit, tax free. So these two fellows have shown smaller revenues, therefore lower tax. So this is what people started doing. From non-tax holiday regions to tax holiday regions, they were transferring at lower prices than the market value. Why? Because the tax liability of the taxable regions would stay low. And they would use to sell from the tax holiday region, because whatever be the revenue you generate in a tax holiday region, it will be tax free. Because of this, what happened? Government started to lose whatever rightful tax revenue they had to receive, that kept going away because of this effective tax planning. So they brought in the provisions of specified domestic transactions, and it has been there, and 40A2, which you study in your PGBP, used to be there as part of specified domestic transaction. Later on it was removed. Okay, so now let us try to understand what is the coverage in this specified domestic transactions. So what is the purpose? Because of transfer, inter-unit transfer, that is within the company, inter-business transfers within the related parties, would result in undue benefit for one over the other is considered and covered under section 92BA as specified domestic transaction. Now, inter-unit transfer of goods and services referred to under section 80A. So what is this? Where there is any specified chapter 6A deduction, income based deduction, and the transfer of goods or services are done at a price lower than the market value or at a price higher than the market value in terms of purchase, then those transactions will be covered within the ambit of specified domestic transaction. They will get scrutinized. They will see why it is transferred at a lower rate, whether the rate at which it is transferred is benchmarkable or not, whether it is at arm's length or not is what will get checked here. Then inter-unit transfer of goods or services under section 80IA. So 80IA is a specific section and they are telling that inter-unit transfer of goods or services under 80IA infrastructure business for example, and they are telling that there is an inter-unit transfer. This is our example, best example. This is within the company they are transferring, two different units is transferring to a different unit. So where these inter-unit transfer is on account of prices which are different from the market price, and owing to the close connection between the units, this price is being altered, they will be covered under specified domestic transactions. Okay, now business transactions between the assessee and closely connected person referred to in 88. So if there is any other related party, okay, there is another, let us say another subsidiary or an associate or a joint venture, then they transfer the goods in this fashion by misusing the tax benefit available, that will also be subject to a stance pricing study. Sir, how will they know that it has gone wrong, sir? They won't know it has gone wrong. So you are obligated to first show these transactions. You will show these you will disclose these transactions. They will run and check whether you have done it right or not. You will not tell I have done transactions, but all are at arm's length, so nothing to report. No, 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 no. You will report everything, and then you will tell everything is under arm's length. So likewise, these transactions will be reported in your Form 3CEB. Clear? Now, next one. These two provisions, that is inter-unit transfer and inter-business transfer, is applicable to 80IA, IB, ACIC, then 80ID, then 10AA, special economic zone provisions also will cover these issues. So if I transfer from a non-10AA unit to a 10AA unit and I sell it at a lower price to a 10AA unit, and 10AA unit gets lower purchase price. So if you can see it in numbers, you will understand it better. So what has happened here? So the original purchase price should be 20 crores. Okay. Let us say that he has sold it for 50 crores. Original purchase price should be 20 crores. So 30 crores should be profit of the Uttarakhand unit. But what have they done? 50 minus 13 crores, which is how much? 37 crores. So this 7 crores is an undue benefit. 7 crores is an undue benefit which is transferred from these two units to the third unit, to the tax holiday unit, which is resulting in tax revenue loss for the department. That is why the specific domestic transaction is considered. Okay, so now inter-unit transfer of goods or services referred to in section 80A. So other than market value, when you transfer between units, then that will be covered here. Inter-unit transfer of goods or services under section 80IA 8. So within the unit, tax holiday units specifically to a non-tax holiday unit, then that will get covered under 80IA. Business transaction between closely connected associate, joint venture, subsidiary, and another company where the associate or subsidiary or joint venture has a tax holiday unit, company as such does not have a tax holiday unit. If they keep transferring it in this way, then again it will be considered as specified domestic transaction. Now, business transaction between assessee and his closely connected persons referred to under section 115 BAB. This I will separately take you through when we do 115 BAB. But what is the point that they are covering here? 115 BAB refers to newly manufactured company. This provision came in effect from 2019. 2019 when BJP won its second tenure of elections, they came out with a budget, interim budget. That interim budget had a lot of benefits. One of the benefits was section 115 BAA, where they brought down the corporate tax rate from 30% to 22%. Likewise, new companies which are in the manufacturing sector, they have been reduced the tax rate from 30% to 15%, 15%. Okay, so if I am an existing company, I am an existing company, I have another subsidiary at 15%. Okay, and that is a new company. If I transfer goods to the other company, if I transfer goods to the other company only to divert income, then that will be considered as part of specified domestic transaction. So transfer from a non-115 BAB company to a 115 BAB company at lower than market price or higher than market price in terms of expenses will be considered as part of specified domestic transaction. Okay, then finally, any other transaction prescribed which has not been prescribed for the time limit will be covered under specified domestic transaction. Now, generally, this is not an area where they will try to test you because there are lots of provisions under the regular transfer pricing provisions where generally they test you. So my advice would be to go through these transactions. This listing will be more than sufficient, and probably I'll throw in a problem or two in the forthcoming videos where you will be able to understand what is the necessity of such a provision. With that, you can stop it. Okay, fine. So this officially concludes our journey with transfer pricing. We have fully understood the entire gamut of transfer pricing applicable. I will be doing one or two videos on problems, but that will not be happening immediately. I'll start my next series of videos which will be on assessment procedure, and in case on the grounds of time not being available to the fullest extent, and if you want me to speed it up, probably I can do two topics at one time. So probably assessment procedure along with TDS and TCS. That could be another topic because these two topics are definitely tested in every examination. Okay, so with this said and done, we'll probably catch up in the next lecture, which should be on assessment procedure. Thank you guys. Please revise and make sure that you are not lost on any aspect of transfer pricing. Please reach out to me if you have any doubts. Do subscribe and share the channel with people that you know so that many will get benefit out of this help. Thank you.